Good afternoon. Welcome to our webinar. This is sponsored by Three Valleys Community Foundation and our Professional Advisors Network, affectionately known as PAN. We'll be going over our end of year giving guide, and we appreciate that so many people have joined us. We hope you come away with strategies that you can use going forward. I'm Dr. Kelly Bowers. I'm the very proud CEO and president of Three Valleys Community Foundation. And joining me today are
Good morning. I am Kim Damiani with Summit Financial Group and board member of Three Valleys.
Good morning. I'm Susan Houghton. I am on the board of Three Valleys Community Foundation and delighted to be able to chat with all of you today.
I'm Dave Ogburn. I'm with Bank of New York and San Francisco, where I'm a client advisor.
Hi, everyone. I'm Ryan Sapanek. I'm David's colleague at BNY, and I'm a senior wealth strategist at BNY.
And we're going to start with just a little preview of what's to come today. So we'll have a brief history of Three Valleys Community Foundation and our beginning and our journey. We'll then go right into our Professional Advisors Network and our Donor Education Series program, and this is the first of that. And then we'll roll out the Three Valleys Community Foundation End of Year Giving Guide, which is, of course, what brought you here. Feel free to place questions in the Q&A, not the chat, throughout the webinar. We'll be sure to respond and answer as we go along, and we'll also be creating a list of FAQs that we will publish and post. At this part, we'll have Susan take it away.
Thank you. Good morning. Thank you all for joining, or I know that we're recording this, so it might be good afternoon or good evening for those of you who are watching our recording. For many of you, it might be the very first time you've heard about Three Valleys Community Foundation, so we wanted to just take a moment and share with you a little bit about our history. Next slide, please. We have been in formation for about 4 years, but we're one of 750 community foundations nationwide, 300 of which are accredited. Chances are you are familiar with some of the names and the logos on this list. Our goal is really to serve as a geographical philanthropic hub. And when we say that, it's about connecting individual donors and growing the philanthropy in our region. Sometimes individuals make gifts to nonprofits, to 501c3s for a variety of information and reasons. It might be an instant transactional gift, and we're happy to facilitate and bring experts to help along those lines and educate folks. But our goal is really transformational giving, so that we move from transactional to transformational. And by doing that, our mantra, give, grant, and grow, all of us can grow our region together. So today is more about the individual donors. And if you look at our history, this is why we started. It was because we took a look at the GDP in our area. Back in 2020, it was 42 billion. And of that, less than 0.5% was really going to nonprofits in our area to grow the philanthropy. We knew we wanted to increase that. The norm in our country is about 1.5 to 2%. And since 2020, our GDP has grown. So we're now at about 47 billion. So our goal is to really help individual donors connect with the nonprofits in our region. We have a variety of folks on our call today. Some are individual philanthropists, some are people wanting to get into philanthropy. And we know we have many nonprofit leaders. We're not going to be focusing on the transactional how to get donors as part of this webinar today. This is really the donor perspective, and how do we grow our donors? How do we help our donors with our philanthropy experts to make those gifts? There are a number of organizations in our area, Center for Excellence in Nonprofits, Tri-Valley Nonprofit Alliance, who really help nonprofit leaders understand how to do that end-of-year giving letter. And we encourage you to talk to those organizations because they are the experts to help nonprofits with that training. So with that, I'll turn it back over to Kelly. So thank you so much.
And so I just want to preface it with Three Valleys Community Foundation's vision and mission. This is something that guides every action, every decision, and every activity that we engage in. So we do envision a community where everyone has the opportunity to live a full and rewarding life, and all of you are part of that. And this is our contribution to help make sure that we tap into that. And of course, our mission is accomplished through inclusive leadership, which you'll see a lot of our board members are part of us today, and our advisors and our PAN group, thoughtful funding, which is obviously guiding what we do, informed giving, which is what today's about, and then collaborative action, because we're all coming together and going to make it happen. And the short version is we give, we get others to give, we grant, and then we grow as a community And our values are at the core of our being and everything that we stand for. And certainly integrity and transparency, particularly in finances and funding and granting, is key. Our equity and inclusiveness, we embrace diversity. We make sure that everyone feels part of us and has a sense of belonging. And then collaboration and innovation. We're always looking at new and inventive ways to approach things, and we work well. So our next part is we're going to go to our Professional Advisors Network. And we're very fortunate that Kim Damiani is part of our board, and she's also the chair of our PAN group. And she's our leader, part of our leadership team. She just brings a wealth of leadership and financial expertise to her role in various government organizations. She served as the board chair and treasurer for the Pleasanton Chamber of Commerce. And she also played a really pivotal role in fostering community growth and economic development. She joined Summit Financial Group in 2018 as a certified financial planner, leveraging over a decade of experience in the financial services sector. She's a Bay Area native, and she's deeply rooted in her commitment to giving back to her local community. She finds fulfillment in educating teens through financial literacy work. So Kim is going to take it away and tell you a little bit more about our Professional Advisors Network, affectionately known as PAN.
Thank you, Kelly. The Professional Advisor Network for Three Valleys is a group of financial professionals, including wealth and financial advisors, estate planners, bankers, and insurance professionals that have committed to helping grow philanthropy in our region. So we ensure that Three Valleys leadership is up to date with the latest gift and wealth transfer strategies and industry trends. And we have also committed to providing education to our donors, nonprofits, and other advisors here in the Tri-Valley. We are thrilled to present today's topic of year-end gifting strategies. And we have two experts here to help simplify the various ways that your donation can make an impact. David Ogburn, he is a member of our Professional Advisor Network and is a certified financial planner and senior wealth strategist with BNY Wealth. He advises individuals, families, family offices, nonprofits, and other institutions on how BNY Wealth can help them reach their financial goals. He has more than 25 years of experience in the investment and financial services industry. And prior to BNY Wealth, he was an executive director at JP Morgan Private Bank. And he resides here in Alamo with his family. With Dave is his colleague, Ryan Sapanik, a senior wealth strategist with BNY Wealth. He is a California certified specialist in estate planning, trust, and probate law. Ryan focuses on complex issues surrounding all areas of trusts, estates, and financial planning impacting wealthy families, corporate executives, and business owners. Prior to BNY, Ryan was a shareholder at a very distinguished Bay Area trust and estates law firm. Ryan resides with us locally, although he does cover the entire Western region in his work with BNY Wealth. We are very grateful that they are both willing to share their expertise and perspective with us here today. And I now invite Dave to kick off our discussion.
Great. Thank you, Kim. Thank you first and foremost for the introduction, and thank you, Kelly and Susan and the entire staff and board of Three Valleys Community Foundation for all the work you do in our community. And then thank you all for joining us for this call today. I think this is something that, like Kelly said, is geared toward donors, but for our nonprofit clients as well. I think it's a great introduction to some tax saving strategies that you can in turn be sharing with your donors. As Kim mentioned, really it's a kind of a top 10 list that we intend to go through of some tax savings tips that's by no means exhaustive or comprehensive. In fact, there's a whole nother list we could have added to this. But these points that we're going to cover, we think are most relevant, one, especially in light of an upcoming election, and two, especially in light of what could be some significant tax law changes next year as the Tax Cuts and Jobs Act is set to sunset at the end of next year. So, what Ryan and I thought we would do is just do more of a fireside chat going through each of these points one by one to cover all 10. I should also point out that we're going to provide this list and make it available to all of today's attendees. We'll post it to the website as well. And I also want to solicit and suggest your input. So, please enter your questions into the chat, and we're more than happy to answer the questions as we go along. Grace and Beth will be doing that And if there's something we can't address during the call, we can circle back after as well. So with that, Ryan, are you ready to dive in?
Yes, David, let's do it. So this is our version of the David Letterman top 10 list. I don't know how many of you are old enough to remember David Letterman, but I was a big fan. So we're going to go through with you, as David said, 10 things that really need to be on your radar as we approach the end of this year. We're going to kick off with completing your annual gifts. Each of us this year can give up to $18,000 per person. That amount does not constitute a gift for federal tax purposes. So it does not use up what's called our lifetime gift and estate tax exemption, nor does it incur a gift tax. So this is a freebie, and this is something we strongly encourage our clients to do, to utilize this annual gift exclusion to transfer wealth to, for instance, the children, the next generation. So you can reduce your taxable estate if you're subject to the estate tax. And even if you're not, you get appreciation out of your estate and you allow it to grow in the possession of your children or other folks. We have a lot of clients who really utilize this in a great way. For instance, we have an ultra high net worth client who has a very large extended family, and they cross gift among the different lines of descent. And it comes out to approximately $250,000 per year going to the next gen without using any lifetime exemption or incurring a gift tax. A lot of folks like to make these annual gift exclusion gifts into an irrevocable trust rather than outright to the next generation, such as to an intentionally defective grantor trust or an irrevocable life insurance trust. In that circumstance, if you're going to use an ILIT, an irrevocable life insurance trust, you need to issue what's called CREMI notices to the trust beneficiary. So you need to plan ahead. And on that point, we really stress that people need to be pushing forward on completing these annual gifts preferably by December 1st of 2024. There's one rule that people get tricked up on. An annual exclusion gift is not deemed to be complete by the IRS if made by a check until that check is in fact cashed by the recipient, right? So if I hand $18,000 over to my child, that doesn't qualify. My child, in fact, has to turn around and deposit or cash that check. So again, it's really important that this process gets started as soon as possible, and preferably by December 1st. Now, that rule is different than charitable contributions. Charitable contributions are deemed complete when the donor hands the check over to the charity. So, that's another tricky thing that we need to be aware of. Just last week, it's notable that the IRS issued what's called a revenue procedure that identified the inflation adjustments for next year. It includes an increase in this annual gift tax exclusion amount from $18,000 this year to $19,000 next year. So keep that in mind. The second bullet point here speaks to another freebie, which are tax-free transfers on behalf of another person to pay for education or medical expenses. The big caveat here is that those payments need to be made directly to the provider, right? So straight to the school, straight to the medical institution. You can't hand it over to the person you want to make the payment on behalf of, and they then pay it over to the institution, right? So you have to make the payment directly to the institution. This is a great way, for instance, for educational expenses, instead of using a 529 account, You can instead make tuition payments directly to the educational institution. And now you're free to use your annual exclusion gifts to fund irrevocable trust rather than that 529. And a 529 is sort of an IRA for education expenses. So a lot of folks like to do that. And this, making the direct payments for educational medical expenses, is another great way to reduce estate tax exposure. Okay, so the next topic is consider donating stock instead of cash, and I'm going to hand it back over to Dave.
Great. And one footnote on your comments too, Ryan, and if you want to comment on it, the most effective gift to make is with cash or high basis securities, which is a lead into our discussion now. The reason being that when you gift low basis securities to somebody, they inherit that basis. So I don't know if you want to comment on that, Ryan, that, you know, why you want to use cash or high basis securities when making these annual gifts.
That's right, Dave. So when folks make gifts of non-cash to the next generation, that gift has what's called a carryover basis. When all of us pass, whatever assets we have in our estate, they get a step up in income tax cost basis, whereas assets we have given away, whether outright or in an irrevocable trust to children or grandchildren, they have a carryover basis, so they don't get a step up in basis. So generally, it's a good idea when you're making a gift to your children or grandchildren, make it of high basis assets, high basis stock. So you're not feeding your children or grandchildren an embedded capital gain tax problem. Now that's kind of the opposite of what we think of when we make gifts when we make contributions to charity. And Dave's going to get into that issue. When we make contributions to charity, we want to do something called give away the gain. And Dave, do you want to take it from there?
Sure, I'll take it from there. So in contrast to what Ryan was just talking about, in the case of making a gift to charity, you want to use low basis, highly appreciated assets. In my profession, I take it for granted that people know this, and oftentimes I'm surprised about how I still come across people who only give in cash and they only make donations in cash, and are surprised when I tell them the advantages about gifting highly appreciated securities, specifically publicly traded stock, mutual funds, ETFs. Those are the types of securities we're talking about here, where there's a dual benefit. If I own a share of stock that has a low basis on it and it's appreciated a great deal over time, when I donate that stock either directly to a charitable institution or to my DAF at Three Valleys Community Foundation, I get the dual benefit of, one, the charitable contribution matches the fair market value of the stock. So I get credit for that entire fair market value, not just the basis of the shares. Secondly, like Ryan said, I'm donating that money and I'm not paying any capital gains tax. So all that embedded unrealized gain goes to the charity or the DAF without my having any kind of a tax impact. And then lastly, to the benefit of the nonprofit, they get dollar for dollar. So rather than me selling that stock, paying taxes on that, and giving, let's call it just for easy math, 50 cents on that dollar to a charitable organization, they get 100 cents on that dollar, and that's really the benefit of it. As Ryan was mentioning before, I can't stress enough that you don't want to wait until the last minute. If you're going to be transferring shares of stock to either a DAF or to an institution directly, you're going to want to get that process you want to undergo that process early, because it might take some time to process that. I know that on Three Valleys Community Foundation, I think they posted the stock transfer instructions on the website. So you can go to the website and then share that with the institution where you hold that stock, and they can affect that transfer. But again, don't wait until the last minute. And Ryan, I'll give you a test question here as we transfer it over back to you. What should somebody do if the fair market value of the stock that they own is less than its basis?
Great question, Dave. So in that circumstance, what you want to do is you want to not give that asset over to the charitable organization, because there's no embedded capital gain there, so you're not giving away the gain. What you want to do is you want to sell that asset that has the loss, take the loss, you can use that loss, and now you have the proceeds, and now you can give the proceeds over to the charity. That's the better way to use it from a tax perspective. Okay, so this next slide, there are a lot of IRS rules around donating capital assets. I'm going to start with if you're a business owner and you're anticipating selling your business, and you want to give some of a minority interest in that business over to charity because you want to avoid the capital gain. One important rule you have to keep in mind is you have to contribute that private company stock before you enter into any kind of binding legal obligation with respect to that sale. Because what the IRS will say is if you give it over to charity after you enter into a legal binding obligation to sell your business, then you can't shift that income over to the charity. You have to, it'll be assigned to you. It's called the assignment of income doctrine. So if you have a private business interest and you're looking to give it to charity, you have to do so before you enter into a binding legal obligation. Think of an LOI, a letter of intent. Next, giving away assets, generally what you want to keep in mind is if you have stock, you want to wait until you hold that stock for more than 1 year. So it qualifies for long-term capital gain. And now you can deduct the fair market value of that stock when you give that stock to charity. If it's short-term capital gain, meaning you've held it for 1 year or less, generally you're limited to deducting the cost basis to get your charitable income tax deduction. More generally, there are some adjusted gross income limitations on how much you can deduct each year from your tax return. Generally, for cash gifts, you can deduct up to 60% of your AGI, your adjusted gross income. And for gifts of long-term capital gain assets, you can deduct generally up to 30% of your adjusted gross income. You'll see on the slide, this slide speaks to giving assets like real estate and closely held stock to private foundations. That's a different rule. So for giving to private foundations, you're generally limited to 30% of your AGI for cash and 20% of your AGI for other assets. And if you want to give real estate or closely held stock to a private non-operating foundation, you're generally limited to deducting the cost basis of those assets, right? So if you give cash or long-term capital gains to a charitable organization, to a DAF, 60% cash, 30% long-term capital gain of AGI. Private foundations, different rule, 30% of AGI for cash, 20% of AGI for other assets. And for non-private, non-operating foundations, real estate, closely held stock, limited to cost basis. And with that, I'm going to hand it back over to Dave to talk about optimizing giving with a donor-advised fund.
So this might be somewhat of a commercial here for donor-advised funds and Three Valleys Community Foundation in particular. But I would say from where we sit, and Ryan, I'm sure you could attest to this as well, we've seen a market increase in the number of clients that we work with that have opted for using donor-advised funds as opposed to private foundations. In addition to the IRS limitations that Ryan just talked about, generally the reasons why clients are more often than not now opting for donor-advised funds is one, just the cost, and two, the ease of use. There's a tremendous amount of costs associated with establishing and managing a private foundation, from legal costs to accounting and audit costs, staff, and the like, versus a donor-advised fund where a lot of that infrastructure is built in at a donor advised fund sponsor like Three Valleys Community Foundation. The other big distinction, and many of you I'm sure are aware of this already, is that a private foundation does have a distribution requirement of 5% annually, and that distribution requirement doesn't exist for a donor advised fund, although some donor advised funds given multiples of that as people get money back out to the community. The other thing that a community fund in particular brings to the table is the philanthropic advice that you might not have access to within a private foundation, and oftentimes have to leverage outside resources for that, and the community support. Just given that community foundations are oftentimes convening organizations within the community and matching donors with community organizations to help them achieve their respective goals. Those are just some of the key reasons why we've seen a market increase in the use of DAFs versus private foundations. We could have a whole presentation on the advantages and disadvantages associated with that. But Ryan, why don't I turn it back to you for talking about accelerating plan gifts?
Great, thanks, David. One thing I just wanted to add on the donor advised fund, which I've been seeing a lot out there. I completely agree with Dave that the trend has been and continues to be that folks really love the ease and the simplicity of using a donor advised fund, whereas many years ago, people would sort of default to the foundation. And, I think generally people oftentimes think, well, I need a foundation if I really care about legacy, right? If I really care about teaching children and subsequent generations about wealth, about giving. But what I've been seeing is that DAFs can be used to accomplish those same purposes, right? So with a DAF, you set up the donor advised fund, and typically the person who sets it up is the advisor. So when they contribute assets to the donor advised fund, they are the person who recommends grants and recommends investments, but they can name their children and potentially subsequent generations as the successor advisor, right? The person who's next in line to make recommendations of grants and investments. So the DAF can really be used as this legacy tool, right? To kind of teach children and subsequent generations about how to give and how to manage investments within a charitable organization, not just a foundation. A DAF is equally good in that sense. And again, it's a lot more, it's a lot simpler and it's a lot easier to use. Okay, so accelerating planned gifts. We have a historically high, what's called standard deduction. So the amount we can all deduct on our tax return is this year it's about just shy of 15,000 for single filers and just shy of 30,000 for joint filers. That's a very high number. Charitable deductions are generally itemized deductions on our tax return. So in order to itemize deductions, we have to exceed that standard deduction amount for it to make sense, right? Otherwise, we don't itemize deductions. We just take the standard deduction. If you're married, you've got to exceed that just shy of $30,000 amount. So one strategy is to, in 1 year, bunch together your charitable deductions, for instance, to a DAF, to a Three Valleys Community Foundation DAF, to exceed that 30,000 amount. So you can take a bigger deduction and therefore get a bigger tax benefit. And in the following year, take your standard deduction rather than equally taking the same amount of charitable deductions in 2 years. That's really a great way to accomplish some tax savings. No, I want to note that in 2026, the Tax Cuts and Jobs Act, that's the act that was passed back in 2017, that is set to sunset on January 1, 2026, and a lot of tax laws are set to revert to what they were in 2016. And one of those rules is that the standard deduction is set to shrink considerably. For single filers, it's set to shrink from, as I said, just shy of 15,000 to 8,350 for single filers. And for joint filers, from just shy of 30,000, as I said, to just shy of 17,000. So we're going to have a smaller standard deduction. So there may not be as big of a need to bunch charitable deductions if that Tax Cuts and Jobs Act doesn't get extended. But for this year and next year, bunching charitable contributions is a great strategy. We have to exceed that standard deduction. David, I'm going to hand it back to you to talk about QCDs.
Great. And I'll just add on to your comments, Ryan. One of the other advantages that I mentioned about a donor advised fund is that there's no 5% distribution requirement from year to year. So if you have a year where you have, let's call it high ordinary income, a high AGI, adjusted gross income, as Kelly put in the chat, those are years where you can bunch those contributions, get credit for contributions in that tax year, and then not have to give all that money out right away, outright to a single organization or multiple organizations, but you can do that over time and allow those assets to grow within the donor advised fund. So that's, again, just another one of the benefits of a donor advised fund. Qualified charitable distributions, QCDs, actually one of my favorite topics, and another topic that I find is not very well known out there. But when people learn of it, they become very interested in it. So if anything, as advisors, it's a great topic just to raise with your clients to make sure that they know about it. And I think that's true for nonprofit organizations, making sure that your donors are aware of it. So qualified charitable distribution can be made by individuals above 70 and a half years as part of that Tax Cut and Job Act and the Secure Act. Some of those ages at which you're required to make a required minimum distribution or an RMD from your IRA changed. The QCD allows you to make a distribution of up to $105,000 this year. It started at $100,000, went up because of inflation, is set to go up again next year as well. And in lieu of taking an RMD, you can instead make a qualified charitable distribution directly to a nonprofit. It's important to point out that you cannot make it to donor advised fund, to your donor advised fund account, but you can make it to a special purpose fund within a donor advised fund sponsor, such as Three Valleys Community Foundation. The dual benefit of this QCD is similar to what we talked about when we were talking about using stock to make a charitable donation. One, $105,000 that you donate through this distribution does not get added to your AGI, whereas an RMD does. So it keeps you in a lower tax bracket potentially. And then secondly, similar to what we talked about before, the nonprofit gets $105,000 dollar for dollar. So when you make an RMD, not only does your AGI go up, but you're forced to withhold taxes at ordinary income tax rates. So in this situation, you forego the taxes and the charity gets dollar for dollar on this. There's also a small provision, we won't go deeply into it, but the same act allowed for what is a one-time, lifetime $53,000 contribution from that $105,000 that could be used to either fund what's called a charitable remainder trust or a charitable gift annuity, a CGA. I would just say from my experience, and Ryan would love to hear you on yours as well, I have not seen a lot of interest from our clients specific to using that to fund a charitable remainder trust because there's some costs associated with establishing a trust, and it's a really small amount of money relative to the cost of establishing a charitable remainder trust. I have seen people express more interest in charitable gift annuities because those rates, because where interest rates are currently, are at historically high levels and allows people to lock in those rates at these currently high interest rates. So, Ryan, I don't know if you have anything to add there or if you want to move on to the next topic.
Yeah, Dave, I agree. The rule from Secure Act 2.0 that permits $50,000 inflation adjusted, so $53,000 this year, contribution from an IRA to a charitable remainder trust. It just doesn't make sense because the cost of creating that CRT and administering that CRT likely does not make economic sense to do so just to make this contribution of the IRA to the CRT. I have seen charitable gift annuities, however, that's a different animal. Just a few other points. I just want to emphasize that this QCD rule, it applies to IRAs, as Dave said, and not 401ks. And I also want to emphasize something that people get tripped up on. The QCD age, the age in which you can make a contribution directly from an IRA to a charity, is 70 and a half. But the RMD age, right, the required minimum distribution age, is 73. It used to be aligned. It used to be 70 and a half for both QCDs and RMDs, but now it's different as a result of the Secure Act. So QCD 70 and a half, you can make a distribution directly from an IRA to a charity, but it doesn't constitute an RMD, or required minimum distribution, until you hit the age of 73. And that RMD age is in fact going to change to 75 come 2033. And then just one more note, that QCD amount, which is $100,000 adjusted for inflation, which is $105,000 this year, it's scheduled to go up next year, and the estimates are around $108,000 for next year, 2025. Okay, so reviewing and updating your estate plan. I am as Dave said, a former private practice trust and estate lawyer. This is a really important issue that folks out there review and update your estate plan on a regular basis. I typically tell people at least 5 years, better yet, every 2 to 3 years. I, for instance, at BNY, on behalf of clients, now that I don't have a billable rate, right? I do this work on behalf of our clients every 2 or 3 years. And why is it important to review and update your estate plan every 2 to 3 years? Well, we have a lot of changes in tax laws every year. We were just talking about the Tax Cuts and Jobs Act of 2017, which is to sunset at the end of 2025, right? January 1, 2026. All these laws revert back to where they were in 2016. The lifetime exemption is scheduled to drop in half. Individual income tax rates are set to go up quite a bit. We talked about some other laws that are set to go back, like the standard deduction. The alternative minimum tax is going to come back into play because the exemption for the AMT is going to go down. A lot of things going on. All of that affects your estate plan, right? And additional to changes in tax laws, as the years go by, our asset composition changes. We have a change in family dynamics. Children get older, grandchildren are born, grandchildren get older. All of that impacts how you want your estate plan to be structured. At a basic level, when we're talking about an estate plan, everyone should have in place what's called a foundational estate plan. That means we should all have a will. We should all, I think most people, if not all people, should have a revocable trust. Why a revocable trust? Well, you don't want to, when you pass, have your heirs have to go to court, because court in California is not a place you want to be. It takes a long time. It's very costly, and your assets are not going to be administered at a quick pace. So a revocable trust, having your assets titled in your revocable trust, keeps you out of probate court, keeps your affairs private. All of that is really important. So you have a will, a revocable trust, and you also need your powers of attorney. Those are the documents that govern the period if and when you become incapacitated to the period you pass. The powers of attorney address who manages your finances, who manages your healthcare decisions if you can't make those decisions yourself. You want to have those 4 documents: your revocable trust, your will, power of attorney for finances, advanced healthcare directive. As I said, reviewed every 2 to 3 years for changes in tax laws, changes in asset composition, changes in family dynamics. The fiduciaries you name, your executor, your trustee, your agent, that may change. Your children may get older. You may want to name your children in those positions. Your distributions under your revocable trust and your will. We want to make sure those are as desired. They may change as the years go on. For example, you may have a family member who has special needs. You may have a family member who has become wildly rich and they don't need the funds. And if you give them the funds, you make their estate tax, you give them estate tax problems, right? So you want to reevaluate those issues every year. You also want to evaluate your retirement plan accounts, your IRAs, your 401ks. You want to look at your life insurance policies. You want to make sure that the beneficiaries who are designated in your retirement plan accounts and your life insurance policies are as desired. We've had a lot of changes in the retirement plan laws in the last few years with the Secure Act and the Secure Act 2.0. For example, we no longer have what's called the stretch rule unless you're something called a designated eligible beneficiary, which generally means spouses, minors, people who are chronically ill or disabled. Unless you fall into one of those categories, if you are the beneficiary of a retirement plan account, you have to pull out all the assets within a 10-year period. And if the person who created the account passed away after the required minimum distribution age, you have to pull out assets every year. And as Dave said, there are income tax consequences to that. It may be better to designate a spouse. It may be a good idea to designate something called a charitable remainder trust, in which case you can stretch out the payments to the beneficiaries for a period longer than 10 years. You want to think about whether the charitable remainder trust makes sense instead of one of the other charitable vehicles like a foundation, a DAF, which I'm a big fan of, as Dave said, or a charitable lead trust. On the charitable remainder trust front, if you're expecting a large capital gain event, it may make sense to do a charitable remainder trust. So when that asset within the charitable remainder trust is liquidated, you could defer the capital gain. It's a very nice technique. The last thing I want to just note is something called a letter of wishes, which I'm a big fan of. This is a document that you can write in your own language, in your own handwriting, to explain your wishes for your wealth and how you want that wealth to be used, for instance, for charitable purposes after you're gone. A lot of our clients like a letter of wishes. Technically, it's not binding, but it is sort of part of your estate plan. And if anyone were to ever question your intent behind your estate plan, they can refer to your letter of wishes. I'm going to hand it back to Dave, and he's going to talk about changes to the federal estate and gift tax limits.
And I'll just add to Ryan's comments, what he referred to as foundational planning. I call it the starter package, or estate planning 101. And the important thing as a next step is, once you get all that planning in place, making sure that all of your assets are titled properly. For instance, titling your home in the name of your revocable trust to avoid probate for any assets. Now, and as much as that applies to most of us who live in California, there is another level of planning that applies to many clients who might either be in a position where they have an estate tax liability, or maybe approaching that situation, or with the potential tax law changes as the TCJA sunsets at the end of next year, find themselves all of a sudden with an estate tax problem. So there's probably no single most topic that we've been talking about more with our clients than the potential that this lifetime exemption amount that's at a currently historically high level might sunset and end up on an inflation basis roughly half of where it is currently, and what the implications are for families when it comes to their goals and their desires about how they want to transfer wealth to their family and how they want to transfer wealth to have an impact in the community, and what that balance might be, and wanting to do so in a tax efficient manner where they're not losing part of their estate to taxes. It is a use it or lose it proposition as it stands right now. And the advice that, and I'm sure you have some comments to add on here as well, Ryan, in as much as you've had so many of these conversations with our clients, the advice we're giving to our clients right now is to start early. So you've heard us say that a few times. But one aspect about this is that if there is another level of planning that our clients want to or need to undergo, in the face of these potential tax changes, realize that attorneys, tax and estate planning attorneys, CPAs, appraisers who will need to appraise private assets, real estate, business interests, they're all going to be very busy come next year. And so you want to make sure that you get a jump on any planning you want to do, even if it's just to put the planning into place and determine where to go from there based on what tax law changes might or might not actually come to fruition. So Ryan, I'll turn it back to you.
Yeah, just a couple things to add to what Dave was saying. This is a big issue, right? The lifetime gift and estate tax exemption, which means the amount you can transfer at life and during your passing without incurring the 40% gift and estate tax, is historically high, right? It's 13.61 million this year. It's going to increase to 13.99 million next year, 2025. That was issued by the IRS last week. And then on January 1, 2026, it's set to decrease to 7 million. So get cut in half, right? Unless Congress acts. We'll probably get a little more clarity next week after the election results. Hopefully we'll have the election results to reevaluate the likelihood of that exemption dropping or Congress passing a law to extend it. One thing I want to note that's important is if the use it or lose it, right? 13.61 million is going to be just shy of 14 million next year, and then it's set to drop to 7 million. The amount you're going to lose, right? You're going to lose 7 million if Congress doesn't act. It's going to drop from about 14 million to 7 million. You have to use up the portion of your exemption that is that second 7 million, right? In order to use the portion you're going to lose. So if you have not used any of your exemption and you gift 7 million of your assets to an irrevocable trust for a child, you will not have used any portion of the exemption that you're going to lose. If you gift 8 million, you will have used 1 million of the amount you're going to lose, right? So you have to cut significantly into that second 7 million for the gifting to make sense if the purpose for which you're making that gifting is to use up your exemption. So you really have to be thinking of gifting, if you haven't used any of your exemptions, somewhere in the neighborhood of 9, 10, 11 million for it to make sense to use up the portion of your exemption. So if you, for example, gifted 12 million and the exemption drops, you will have used 7 million of the exemption that you will not have lost. And then another 5 million, right? If you're gifting 12 million, you'll use 5 million of the portion of the exemption you will be losing, right? It's that second 7 million of that 14 million. So I just want to make sure everyone's clear on that. Okay, so next topic here, we have maximizing employer matching opportunities. Really important. There are a lot of employers out there who are willing to match your contributions to charity, and a lot of people never inquire and don't know about this. So definitely put it on your radar as a to-do list to ask your employer if they will match your charitable contributions, and if so, to which organizations, what programs. A lot of employers will do that. A lot of them are incentivized to do that because they can take a charitable deduction. So a really important issue. I just want to make one more note on the estate plan, on reviewing your estate plan and reiterating what Dave said. It's really important to do that. I recently reviewed an estate plan where somebody hadn't had it reviewed in about 8 years, and I looked at it, and they had subsequently gotten a divorce. And they didn't change the beneficiary in their estate plan from their ex-spouse. And when I noted that to the client was shocked. So just to underscore, you really need to be reviewing those estate plans. Even your irrevocable trust, there are some circumstances with irrevocable trust when we're talking about exemption use, where you may be able to modify an irrevocable trust, a decanting, for example, other kinds of modifications. So have that estate plan reviewed. I'm going to hand it back to Dave, and he's going to talk about reviewing your family foundation structure.
Great. And I'm only going to touch on this. And by the way, Ryan, I think we all have heard horror stories about people who didn't take the time to change their beneficiary designations and some of the unintended outcomes or consequences of that. I'm only going to touch on this because we already kind of talked about some of the advantages and disadvantages of a donor advised fund versus a private foundation. I would just tell you that I've seen in two different types of situations over my career where a private foundation has folded into a donor advised fund. Has been in one situation where the foundation is sunsetting and is deliberately sunsetting and spending down. And that's more of a fortunate reason. The other reason is family discord and disagreement over the mission of the private foundation, to where they couldn't come to an agreement and ended up dissolving or folding the private foundation into a donor advised fund, or one or more donor advised funds from there. So that's all I'm going to talk about on that topic. As we talked about, first and foremost, this is not meant to be a comprehensive list. There's a whole number of different topics we could talk about that could be year-end tips as well. Certainly things that come to mind are tax loss harvesting, reviewing your withholding amounts, making sure that you're withholding the right amount, or that your employer is filing on time to avoid penalties and additional fees. And then certain things like not buying a mutual fund right in front of a year-end distribution, or selling it before that year-end distribution. Those are some things that I think we'll save for future topics. I also wanted to add again that Ryan and I, while Ryan's a former practicing attorney, neither of us are practicing attorneys. So anything that we talked about shouldn't be deemed as specific tax or legal advice for you. And that we would all encourage you to make sure that you talk to your legal, tax, and financial advisor about some of these topics specific to your situation. So with that, I just want to thank everybody again for attending, and thank you, Kelly and Kim and Susan, for the opportunity to present here. And Kelly, I'm going to turn it back to you.
Thank you. That was fabulous. If I had my hand clap being featured, I would do that. So I'm just going to do it. Thank you so much, Dave and Ryan, from BNY Mellon. I also wanted to thank our sponsors for PAN, our Professional Advisors Network Group. We meet as a lunch and learn. We meet periodically. Kim is our chair. Dave is part of it, and our folks behind the scenes answering questions are Grace Nash and Beth Putner, and they are also all part of our group, and we have some audience. But we did want to thank Sensiba and Summit. Those are two of our sponsors for our lunch and learns, and that's been really great. We just want to acknowledge them. And then this is the time now for more questions. We've answered a few as we've gone along. Feel free to put them in the Q&A and also send them later, because we will be creating an FAQ. I know for me, if you notice, I was putting the acronyms in. That's sometimes my questions. I don't have all the vernacular down yet. So that's why I was putting some of those in. But it's a lot of information. It's a lot to digest. We're also going to put into the chat our actual checklist. And that's something, I know we have a lot of nonprofits here with us today. So that checklist is something feel free to share with your donors and encourage them to come and watch the webinar, because some of these things may be exactly the dilemmas or the strategies that they're grappling with, and it can really be useful information for them as they make their donor decisions.
So as Kelly shared, we will be putting a PDF version of our year-end giving guide here into the chat, as well as providing that to all of you who participated today via email. We are already brainstorming topics as our professional advisor network. What can we provide in the coming year that would be of value? We're already considering topics of family philanthropy and changes to the estate tax exemption that Ryan and Dave already started to touch on today. We may do something really specific to that where we can dive into the weeds, but we would love to hear from you. What would you like to learn about? Put those ideas into the chat, or when we send our follow-up email, there'll be a really short survey where you can share with us some of the ideas that you have. So thank you very much, and you can continue if you have any questions. We still have some time to put those into the Q&A.
I know one of the questions that has come up to me before was, where do you start? There's so many factors here, and not everyone has the high wealth and net worth means of some of these strategies. But if you were just going to start, what would you say is the best starting place?
Yeah, I think a starting place is to have a plan in place, right? I think having a plan in place and acting sooner than later it's going to be November at the end of this week, right? And the thing that's top of my mind for our clients is if you have an intent to utilize your annual exclusion gift exclusion, and you have an intent to make charitable contributions, do that sooner than later. Do not wait until December. Get it going well in advance of December. There are a lot of tricky rules that come up. We covered several of them. So make those annual gift tax exclusion gifts now. Make those charitable contributions now. Again, I'm a big fan of a donor advised fund. Working with Three Valleys Community Foundation and their donor advised fund is a great avenue. Even if you don't know what the end charitable organization should be, you could put your assets that you want to contribute into the DAF. You could bunch those charitable contributions to exceed your standard deduction for a joint filer that's just shy of 30,000, and then you can make a decision at a later time who the end charitable organizations are. Get your estate plan reviewed. If you have a taxable estate, think about that lifetime exemption, how it's going to drop on January 1, 2026. Come the end of next week or the week after when we get the election results, reevaluate to see the likelihood and determine the likelihood that that exemption is going to drop. If it's going to drop, in other words, Congress is not going to pass a law to extend it, put a plan in place to use up that exemption if you have a taxable estate. Those would be my tips.
So I think that wraps it up for us today. We had a great turnout. We appreciate everyone being here and taking the time. Oh, we do have one. And we also want to thank everyone who made it possible. So thank you. We will be making the recording available. Have a wonderful day.